If you are a T-bill investor like me, you probably started looking for alternatives when the US Federal Reserve finally announced rate cuts. For me, that search for a safe investment that still offers attractive returns has led to a surprising candidate, Sheng Siong. Let's talk about why I think Sheng Siong stock stands out as a defensive dividend play with growth potential. Hi everyone, I'm Singapore, just a lion sharing my research. So this is not financial advice. Please exercise your own due diligence before making any investment decision. Back to the question, why Sheng Siong? When I first made the recommendation, the price was at $150 per share. Now I just checked, it's around $165 per share. Price has appreciated around 10%, but it still offers an attractive yield at around 3.8 to 4%. That's still better than Singapore's T-bills, which is currently around 3.1%, and I think it will continue to drop further when the Federal Reserve further cuts rates. But the appeal goes beyond just the dividend yield it provides. One of the most critical things for dividend stocks is the sustainability of these dividends. And Sheng Siong has successfully positioned itself as a low-cost leader within Singapore's supermarket space. And we see that while competitors like Giant are scaling back operations, Sheng Siong continues to increase the number of stores. Even the rise of online grocery platforms hasn't dented their market share as people continue to buy fresh produce after seeing them physically. And delivery platforms still can't beat the ease of just walking over to get something you forgot. Other new supermarket entrants also tend to focus more on the more affluent segment of the population and targeting the mall goers. So we see the Chinese supermarket Scarlet or even Don Don Donki, a Japanese retailer. These stores tend to compete with NTUC and cold storages, which are located within the same mall. As a result, Sheng Siong is somewhat protected from the harsh competition from other supermarket competitors. Sheng Siong also prices its items at each outlet differently depending on the location and the surrounding competitor. In contrast, FairPrice, their main competitor, adopts uniform pricing for its goods across all stores. This price discrimination allows Sheng Siong to maximize profit for each store. Could new supermarkets copy Sheng Siong's strategy? Definitely, but Sheng Siong being their first comer has actually built up significant scale. This enables them to enjoy greater cost savings, whether it's from negotiations with suppliers or to spreading out the cost of automation. That said, the increased competition has actually pushed up rental for HDB outlets and will continue to put pressure on operating profits. But management knows how to deal with cost pressures and competition. We know that when Sheng Siong first started its first store, they actually faced stiff competition as there were 5 other provision stores within walking distance of it. Yet, by 2004, only one of the competing provision stores near its Ang Mo Kio outlet remained. So with their experience and their in-depth understanding of the local fresh produce supply chain, I believe Sheng Siong can continue to compete effectively and keep those dividend yields in the future. And although Sheng Siong isn't growing its revenues by leaps and bounds, it is slowly expanding its stores in Singapore and China. So there's some potential for growth there, but I would really think of it as a bonus if things works out well. Where Sheng Siong really stands out is its potential to be a defensive stock in downtimes. People will still need to get groceries and other basic necessities, even as they cut down spending during tough times. This makes Sheng Siong likely to survive and keep operating even during economic downturns. Of course, no investment is without risk. As a family-run business, leadership transitions could also pose challenges. But I think overall, Sheng Siong offers a compelling case as a dividend stock. The company has a solid balance sheet, no debt, and strong management team. The neighborhood supermarket business is resilient even in challenging economic times. This means that it can weather storms better than others, and as it scales up its China's operations, there's even potential for moderate growth. At a 4% yield, it is a solid choice for conservative investors. In conclusion, if you're looking for a low-risk T-bill alternative, I think Sheng Siong could be worth a look. If you're more interested in a detailed write-up, I'll leave the link below and you can check it out. Until next time.